Today's Talk About It Tuesday question is, what are some metrics I can use to measure my financial health? Now, I get some great questions every week, but I particularly like this question because it impacts everyone. Everyone can benefit from the answer to this question. And it's interesting that we go through life and we never really consider our financial health or how to even measure it. So I'm going to keep it as simple as possible. I'm going to give four criteria, four measurements that you can look at to determine where you're at on the scale. Now, how healthy you want to be will be dependent upon you. That's a personal thing. But we minimally want to be at zero, right? So we'll have zero, we'll have negative, we'll have positive. And we'll just use, like I said, some simple metrics. So I think the first and most basic metric or measurement that everyone should pay attention to is income versus expenses. And what does that mean? Income is all the money you have coming in from every source, whether it's a job, spousal support, investment income, rental income, business income, whatever money is coming in, that's your income. And you need to add that up and divide that up monthly. It's easier to just look at this on a monthly basis. You can also look at it annually, but for general purposes, look at it monthly. So you have all your sources of income, and then you look at all of your expenses. So that means, when I say expenses, food, housing, utilities, gasoline, entertainment, all the things that you spend money on every single month. I mean, some things you don't pay every month, but you need to divide that into it. So there's some expenses that come quarterly, some expenses that come annually, like some tax expenses, but add that in and divide it up in the month also. And you just put them together. So you subtract your expenses from your income. If you come up with a positive number on one side, then that's great, right? So you have positive left at the end of the month. If you break even, then you're at zero. If the number ends up a negative number, meaning your expenses outweigh your income, then you're in the negative. That's a sign of poor, extremely poor financial health. You're kind of in trouble even if you break even, because then you can't do some of the other things that you need to do, right? So you're in danger at zero. You're in critical condition if you're in negative. And if you're in the positive, that's good. And the higher you are in the positive, the greater that number is on the positive side, the better off you'll be. So that's first criteria we look at, and that's most basic, and everybody should be creating a monthly income and expenses, measurement for yourself. So that's just creating a budget, right? That's how you create a budget. The second criteria that you should look at is net worth. And it's so interesting. Most people only think of net worth when they think of rich people. Everyone has a net worth. Net worth is what your value is financially, right? And so how do you do that? You look at assets on one side and liabilities on the other side. So you'll subtract your liabilities from your assets. So what are assets? Assets are basically anything that has value that you could sell and make money on. So home, your car, collectibles, your business, stocks, bonds, precious metals, your camera collection, your whatever, right? Anything that has value that you could sell and make money from are assets on one side. On the other side are liabilities, meaning debts, right? And so you can have a home on this side or a property on this side and have a mortgage on this side. So the home could be worth $300,000, and your mortgage is which you owe is $250,000 in the debt. So when you subtract that, it's only $50,000 net, right? So you put all of your assets on one column, all of your liabilities, every single debt, credit card debt, if you owe tuition, if you owe on your card, if you have a car note, Every debt that you have, you put on the liability side. You subtract the liabilities from the assets. The number that comes up on the other side, if it comes up that the assets are, you still have money left over after you subtract your liabilities from the assets, on the positive, you have a positive net worth of whatever that number is. If it breaks even, your liabilities and your assets are exactly even, then you have zero. If it turns out you owe more than you have value, then you have a negative net worth. And the larger that number is in the negative, the more critical of a situation you're in. If it's at zero, again, not good, but you can be saved. If it's in the negative, you got to get it at least to zero before you can go positive. The greater you are in the positive in net worth, the better, right? So we have income expenses. You want to be in the positive. You have positive net worth, which would be great, and the larger, again, the better. The next thing we're going to talk about is as a measure that I rarely hear anybody talk about in the financial world is insurance coverage. For things that have value to you that you can't necessarily afford to replace easily, you need to have, or that have a great expense when things go bad, you should have insurance coverage, right? And so it's paying a little to get coverage for a large amount. So homeowners or rental insurance, do you have adequate coverage in your homeowners or rental insurance? Auto insurance, and I'm not just talking about replacement for the car, but if you get into an accident, do you have liability insurance? Do you have adequate coverage for your auto insurance? Health insurance, which is major. That's one of the biggest causes of debt in America. So do you have adequate health insurance so that you can, in case of an emergency or just regular checkups and major chronic illnesses, do you have coverage? So health coverage is important. Health insurance. Life insurance. Do you have adequate insurance for your family to be able to give you a decent funeral at least? Forget about covering your debts when you're dead. That just should go in the grave with you. But do you have adequate life insurance so that your family doesn't have to do a GoFundMe if something happens to you? You may want to explore other insurances, right? You may have assets that are very important to you that you should have, like fine art. Maybe you need to have coverage on those because if you lost it, irreplaceable. So things that are of value to you, do you have adequate insurance to be able to cover those things? That's important. And then we'll look at the fourth thing. I'll break it up into two parts, savings/investments. So why do we have that? Now we're going to break that into parts too. So how do you know whether you have an adequate amount of savings or investing? And if you don't have, again, positive in the income and expenses, then you won't even be able to do this. But so let's look at how do you know whether you have adequate savings and investing? So you got to look at certain things. One, you need to have an emergency fund. And what is an emergency? A lot of those insurances have deductibles. Can you cover the deductible on all of those insurances if something happened? Right? So health insurance, your auto insurance. Can you cover the deductibles for all of your insurance coverage? That's an emergency. Can you cover a major repair? Right, because that happens. That's an emergency. So if your hot water tank went out, if your boiler went out, if you rely on your automobile and the transmission went out, can you cover? That's an emergency. Loss of income for a period of time is an emergency, right? And so if you found yourself without a job or your business had to shut down or something like that, can you feed, clothe, and house yourself until you can get more income? That's an emergency. So you have to have an adequate amount of money available for an emergency. Then I say major purchases, right? So that's another section of saving or investing. Listen, your car is going to break down. It has a lifespan. Can you get another automobile? Can you put at least a down payment to be able to finance another auto? Major appliances, television, refrigerator, things that you have to replace, major expenses. You should have a fund for that. And then, or even I think your vacation is a major expense. You should probably put that. So vacation and recreation, you should put that under there too for the major purchases. And then we have life events, major life events that are inevitable. So if you're unmarried, marriage, births, education, retirement, those are things that require a lot of investment, but you can usually time them out from where you're at. And so you know how many years till you get married, or how many years till you have a child, or even stages in your child's life. If you're going to fund their education or fund different things, you can kind of plan that out over years. You kind of have an idea of when you want to retire, so you can plan that out over years, but it has to be done annually and consistently, right? And so if you look at those criteria, so if you have enough savings and investment to cover all those things, if you can measure it out and you're ahead of the game, that's great. If you're kind of at zero, that's terrible. If you're in the negative in that regard, then you're in critical condition. So you want to have all those criteria, all those metrics in the positive. If they're at zero, get on it now. If they're in the negative, you have some serious work to do. So I'd love to hear how you measure your financial health. I'd love to even hear where you feel you're at in terms of your financial health. Please like, share, subscribe, keep the question. And listen, the algorithms don't know if you just watch the video and don't hit the like button. Please hit the like button if you appreciate it. But keep the questions coming, and I'll see you next Tuesday.